Welcome to week number 3. I hope that you're able to keep up with the materials and have been able to watch the videos that I provided last week. This week, you are going to be reading in chapter 3, which is often one of the more challenging topics for students to master, mostly because there's a lot of misuse of terms in the mainstream media and the general public. And economists do like to be very clear on what the terms are and how they work, especially when math is involved in a variety of functions and laws that we're going to be discussing today. I will try in today's lecture to make sure to use examples that are different from the ones that are in the textbook, simply because the textbook does a very good job of walking you through those examples, but I do know that sometimes students need more examples. So let's go ahead and get ready and begin today's lesson. So today we will be discussing probably some of the more commonly referred to laws and terms when people think about economics, in particular supply and demand. Usually when I ask people what they think about economics, they refer to supply and demand, but I'm not convinced that everybody is entirely certain about what that means. So we're going to begin looking at the market system. And the market system is based on people and businesses who have demand for goods and services, and people and businesses that supply goods and services. So the first thing that I want to do is to talk about the law of demand. It is a law. It does seem to work this way in most cases, and it sort of makes sense. And you think about your own consumer behavior, this sort of makes sense. The law simply states that as the price of a product rises, the quantity demanded goes down. As the price of the product rises, the quantity demanded goes down. Now you'll notice that I'm very particular about using the phrase quantity demanded. I want you to understand that there's a difference between demand and quantity demanded. Demand is an entire function. So if you've had college algebra or some math before, you might recognize a function is simply a way to describe the relationship between two different variables. So in this case, we describe the relationship between price and the quantity of a good that is demanded. So I've given you a demand schedule. And if you were to graph this demand schedule point by point, please make sure you understand how to graph a function. But you'll notice if the price of the potato chips were 25 cents a bag, then there would be 200,000 bags of potato chips that people would desire to purchase. As the price of the bag of potato chips rises, there are less people willing to purchase the bag of potato chips. So if the bag of chips was $2, there would only be 25,000 bags of potato chips demanded per year. So quantity demanded is the amount that would be demanded at a particular price. Demand is the entire relationship between price and quantity. So demand is the entire function, putting it all together. So if I were to say the price of chips rises from $2 to $3, what happens to this graph? Now, A lot of people will say, oh, the price of the product rises from $2 to $3, so demand goes down. But that's not entirely correct. If the price rises from $1 to $2, nothing actually happens to the function. You're just simply moving from one point to another point on that line. In order for demand to decrease, in order for the function to decrease, something else has to change. Not the price of the product, but something else. So for example, what happens if people become healthier and they decide they really don't want to eat as many chips as they used to? And so let's say that no matter what the price is, there are 25,000 fewer bags that are being demanded, no matter what the price is. So in this case, our function actually is going to shift, because you'll notice that at every price, the quantity demanded is actually less than what it used to be. So because there was a change in tastes and preferences, the quantity demanded changed at every price. That's a key phrase. Demand goes down when quantity demanded goes down at every price. So there's a variety of things that influence our demand. We already talked about tastes and preferences. So if something becomes more fashionable, we typically would say that the demand is going to increase for that product. And if it becomes less fashionable, then the demand would decrease for that product. If the number of consumers increases, then the demand for that product would also increase. You simply have more people willing to purchase that good because there's more people in the population of consumers. If incomes increase, it actually has some different effects depending on what kind of good we're talking about. If the good is what's called a normal good, then the demand for that good will increase when income increases. And this happens in many cases. Let's say, for example, that normally you purchase one steak every month, and yet now you get a new job with higher income and you really like steak, and so now you get 2 steaks per month. I didn't change the price of the steaks, I changed the income. And that said, I no longer want 1 steak per month at whatever price. I want 2 steaks per month at whatever price. So my income will cause an increase in the demand for a normal good, but some goods are inferior. If your income rises and your demand for the product goes down, that's what's called an inferior good. It doesn't mean it's a bad good. It just means you really don't want it anymore like you used to. So for example, generic goods are often referred to as inferior goods. Now there's nothing wrong with a generic good, but oftentimes as incomes rise, people decide, I don't really care what the price of the generic is, I just don't want it as much because I have more income to work with. And the opposite would happen if income goes down. The demand for generic goods typically rises. Doesn't matter what the price is, there's more people who would want the generic good because my income went down. So prices of related goods will also affect the demand for a product. But again, it kind of determines what kind of relationship it is that we're talking about. If the 2 goods are substitutes, so for example, you might have pens and pencils, they're substitutes for each other. If the price of good A, let's say pens, rises, then the demand for good B, pencils, will also rise. If pens become more expensive, Everybody's going to shift over to the pencil aisle. Now, if the goods are complements, that means they're consumed together. So, for example, you might have milk and cookies. Those are complements. So if the price of cookies rises, let's say that's good A, then the demand for good B, milk, is going to fall. Now, how much it changes depends on how strong a substitute or complement it is, but there will be some sort of change. We also look about expectations of future prices. If you expect the future price to be higher, then your demand for the product right now is going to increase. You're going to want to go out and purchase it now before the prices begin to rise. So each of these things will cause the entire function to increase or decrease. If there's a change in the price of the good, quantity demanded changes. If there's a change in any of these 5 factors, then we would say that the demand changes. Now, there's also a law of supply, and that simply says that as the price of a product rises, the quantity supplied also rises. And the opposite also holds. If the price of a product falls, the quantity supplied will also fall. So think about it this way. If you're in business and you know you can get higher prices, you would really like to sell an awful lot of those goods. But if you're in business and the prices are pretty low, you might not even be able to make any profit. So you really might not want to even put any on the shelf. So let's go to the supply for potato chips. You'll notice that as the price rises, the quantity supplied also rises. I apologize, the heading should read quantity supplied, not quantity demanded. So in this function, you'll notice that as the price rises, my quantity supplied rises. And just like before, we have the supply function, which is the entire relationship between price and quantity supplied. So if the price of chips were to rise from $1 to $2, what happens to the function? What happens to supply? Nothing happens to the function. Nothing happens to supply. You're just simply going to move from one point to another point. But just like before, there are things that will cause the entire function to increase or decrease, that will cause supply to increase or decrease. So things that will influence our supply might be the number of suppliers. If the number of suppliers goes up, then the supply increases. And that sort of makes sense. There's just more businesses out there willing to put product on the shelf. If the prices of the inputs go up, then the supply is going to decrease. At every price, the quantity supplied will be less because it's more expensive to make the product. So if it's more expensive to make the product, I really don't want to put as many on the shelf as I once did. Prices of related goods in production will also impact our supply. And again, it depends on what kind of relationship it is. For example, if the two goods are goods that you make together, the two of them go together, then they are complements in production. So for example, we had a jelly company. We made orange marmalade. So in the process of making orange marmalade, orange juice is also created. There was an awful lot of juice involved. So you might say that orange marmalade and orange juice are complements in production. You sort of make the two of them together. Orange marmalade uses the peel. Orange juice obviously uses the juice. So if the price of orange marmalade rises, we're going to want to make more orange marmalade. Quantity supplied of orange marmalade goes up. But when I have a higher quantity supplied of orange marmalade, I'm automatically going to be getting more juice. So you would then say that the supply of juice would also increase. Now, if the two goods are substitutes in production, that means you can make one or you can make the other. For example, our business, we made orange marmalade and we made grapefruit marmalade. If I were to know that the price of orange marmalade were going to increase, then the supply of grapefruit marmalade would go down because I would want to shift everything over to the orange marmalade side because that's getting the higher prices. If there's an expected future price that we expect to be higher, then our supply right now is actually going to go down. Why would I want to sell it now if I know that later on it's going to be sold at higher prices? So I would just hold off. So my supply right now is going to go down. And lastly, technology and taxes can impact supply, but it's sort of hard to determine exactly what the effects are because it depends on what the actual change in technology is, and it depends on what kind of tax is involved. So for example, some technology makes it cheaper to produce the items, and then you might say, well, the price of inputs goes down. But sometimes technology actually changes the entire production line. So it might become even more expensive. Same with taxes. Sometimes taxes can actually just be passed along to the consumer and really doesn't affect the producer. But sometimes the producer can't pass along the tax, and then it just makes it more expensive to make that product. So if the price of a product rises, quantity supplied will rise. But if I want to have a change in supply, an increase or a decrease, then one of these factors needs to change. So when we put the two of them together, this is where we get the market system. Supply and demand will always intersect each other. The two functions will intersect, and they intersect at a special point called the equilibrium. And that equilibrium is where the quantity supplied is equal to the quantity demanded at a particular price. So for example, let's say I have the supply and demand for toys, and those two functions intersect. At an equilibrium, it appears as though the equilibrium price is 40. At the price of 40, there's 250 toys that are put on the shelf and 250 toys that are wanted to be taken off the shelf. And we typically say that the market clears at equilibrium. If the market price were $40, businesses wouldn't want to have any more on the shelf, and consumers would be able to be willing to purchase all that was there at the price of $40. Now, if the price is something different, let's say the price were $75. We put the toys on the shelf and a price of $75, the businesses would love to do that. They would put 400,000 toys on the shelf. But at a price of $70, only 100,000 is actually demanded. So the quantity demanded is less than the quantity supplied because the price is too high. And we say we have a surplus. So how does a business get rid of surplus? They lower the price back down to the equilibrium. If the price is too low, then we have a case where quantity demanded is higher than quantity supplied. So if the price were 10, there would be 400,000 toys that were demanded, and yet at a price of 10, only 100,000 is actually willing to be put on the shelf. So you have a whole lot of customers wanting the good at $10, but the businesses don't really want to sell the good at $10. And so we indicate that with a shortage. So the only way to get rid of a shortage is to raise the price. You raise the price back to the equilibrium, and we indicate that the market clears. So we have the law of supply and the law of demand. And in chapter 4, we will examine what happens when supply and demand change. But we must recognize that supply and demand do intersect at a particular special point called the equilibrium. And at this point, we're actually the most efficient that is actually possible. And the appendix to this chapter discusses two concepts which sort of prove why this is a very efficient point to operate in. And this is the idea of consumer and producer surplus. So if you have a supply and demand for a product, what that means is that people are willing to pay certain prices for certain quantities, and businesses are willing to sell certain quantities at certain prices. So those are our supply and demand functions. You'll notice in this particular graph that if the price were $100, if the price were $100, there would be 50 units that are demanded. But the reality is the equilibrium is $60. So if we go to the store and I'm willing to pay $100 for the good, and I look at the sticker and it says $60, I think I've got a good deal. I just sort of saved myself $40. I was willing to pay $100 for this good, and it only cost me $60. So I got a pretty good deal. Likewise, if I was willing to pay $90 and the price was $60, then I might think, oh, I saved myself $30. So I've saved myself a little bit of money. On the flip side, the producers also sort of are gaining. If our supply function shows that at a price of 40, there's 150 toys or whatever this product is that's willing to be put on the shelf at a price of 40. But if the equilibrium is 60, then the consumer says, I was willing to sell it for 40 and I'm getting 60 instead. I'm actually making some money on this. So what we have is a little bit of value that's accruing to the consumer and the producer. And these are what are called consumer and producer surplus. Essentially, consumer surplus is the difference between what you would have been willing to pay and what you actually had to pay, that equilibrium price. And producer surplus, on the producer side, is the difference between what the producer was willing to sell it for and what they actually got for that product. So again, by looking at the supply and demand functions, we essentially recognize that the consumer surplus is the entire area under the demand curve above the equilibrium price. And the producer surplus is the entire area above the supply curve below the equilibrium price. And when you add those two together, you'll notice just geometrically, the largest area that we can get is that entire area. So at an equilibrium price of 60, we've maximized our consumer and producer surplus. Now, what happens if really there are only 150 that are put on the shelf. At the price of 150, you have some consumers who are not going to be able to purchase the good because we're going to run out, because the producers really don't want to put that on the shelf. They don't want to put any more on the shelf. So what we end up with is a piece of our consumer and producer surplus that disappears. So if we do not have 250 on the shelf at a price of $60, we're actually going to be losing some of our producer and consumer surplus. So really what we want to try to do is maximize our consumer and producer surplus, and that's going to happen at the equilibrium. If we don't do that, we end up with deadweight loss, and that's a loss to the market system. So in summary, we talked about the law of demand and demand shifters, and we made sure to focus on the difference between quantity demanded at a particular price and demand, which is the entire function, and all the things that will shift demand. We also talked about the law of supply. We focused in particular that at a particular price, there is a quantity supplied, but supply is the entire function. And also there are shifters which will shift the supply curve. When we put the two of them together, we have the market system. And we discussed that at the market system, if we can get to the point where we clear the market, where we have neither a shortage or a surplus, but that the market price is actually the equilibrium price, then we have maximized consumer and producer surplus, and there is no deadweight loss. But if our prices and quantities are not the equilibrium, then we will experience some deadweight loss. So this chapter sort of discussed the very beginning of supply and demand, and the next chapter is going to extend this concept by recognizing that things are always changing and supply and demand are always being influenced. And we'll also discuss the reality that sometimes there are some failures in the market system.